Hello everyone, welcome to our review of the the practice problems or exercises as we call them for deferred income taxes. So this is the same as we're going to do for homework. Hopefully you've already given it a try and try to set it up. There are lots of different ways to set up a deferred tax problem, but this is my favorite or what I find that makes the fewest errors, helps make the fewest errors to do it in this way. So this problem will be for exercise 1 and 2 will be a couple of years, and then it will actually a continuation of the same company, just later years for the homework. All right, so you'll see the same things, make reference back to it. So that's what we want you to do. So set up parallel or scenarios. What's happening on the tax return, what's happening on the income statement. We start with the income before taxes as given on the income statement, and then make adjustments when we prepare our tax return. That's typically how most companies do their taxes, is they produce an income statement and then create a tax return from that. So when we make the tax return, we're going to deal with the municipal interest. We're going to take that off the income on the tax return. So we're going to subtract that. So on the tax return, our income with just that one permanent difference is be 208. So that's a permanent difference, never going to be taxable. All right, so already we have a difference between what we're reporting to our shareholders and what we're reporting to the IRS. Now, besides that, we have some bad debt scenario. And it gave you, because this is our first year, we don't have any ongoing bad debts from past years. But this year we had our estimated allowance and we had write-offs, and they're not the same. That's what we would expect. In fact, they're different by 7,500. Okay, 11,000 versus 3,500. So on the tax return, we cannot deduct all of what was deducted or taken off on the income statement, so we add that back. And then we had some assets we purchased. They cost $58,000. On the tax return, we're going to depreciate all $58,000 because it qualifies for Section 179. Okay, on the income statement in the 223 is a calculation of a depreciation using the 7-year useful life. Okay. And that's 4,143, half year convention. So half a year of depreciation is 4,143. So our tax accumulated depreciation thus far in year 1, 58,000 over here on the side and 4143. I like to keep track of that separate, make sure we don't miss anything. All right. So the difference between what we deducted on the tax return and what we recorded as depreciation on the income statement is 53,857. So that's how much more depreciation we take on the tax return than on the income statement. So that gives us taxable income on the tax return, which is the ultimate calculation, or on the tax return is 161,643. All right. So jumping in with some the journal entries, taxable income times the tax rate is 21% for corporations. So 33,945 debit, tax expense, credit, tax payable. That's our current tax payable. That's what we're going to have to send in to the IRS based on our 2024 income. All right, now, in addition, we have, for each of these temporary differences, we're going to have either a deferred tax asset or a deferred tax liability. So the bad debts, because we can't deduct until later, we have a later deduction. We can deduct later when they really don't pay us. That's a deferred tax asset because we're going to have that deduction in the future. So deferred tax asset is the difference or the allowance. Our allowance would have been $7,500 on the balance sheet. times the tax rate. So we take 7,500 times 21%, and we get a deferred tax asset of 1575 and a tax expense credit, okay, 1575. That's unusual to credit expense, but with taxes, it can go either way. And I separate them out so that we can see each deferred tax asset and each deferred tax liability separately. All right, so that is one journal entry we need. We record that. Then we look at the depreciation, where our difference is 53,857. Okay, that's the cumulative difference and the difference for the 1 year, because we only have 1 year. And there's only one. There wasn't anything, any existing deferred tax assets. We always want to, in subsequent years, we're going to check what we calculated the deferred tax asset is compared to what it was the year before. But this time we don't have to worry about that, because we only have 1 year. Same thing with the deferred tax liability. We have a difference in depreciation, which is always a deferred tax liability, because we got a big tax deduction now. So later we're going to have to pay more. We're going to have to owe the government more money because we got such a big benefit right now. So take the 53,857 and multiply by the tax rate, 11,310. Debit tax expense, credit deferred tax liability. Okay. There's no comparison to the previous year because there's no existing deferred tax liability. So we'd make it for the whole amount we calculated. And so that is a recording of that liability. Now, it asks for us to figure out what our tax expense is, our net income as well. So if our income before tax is 223 and our tax expense is this tax expense debit, this tax expense credit, this tax expense debit, added up. So add these two together and subtract that one, we get 43,680. Subtract that, get our net income. Okay. On the income statement, our tax expense is current. That's the part that is payable. It's the first piece. And the other two are deferred. And we see less and less of that disclosure on financial statements these days. And then doing our effective rate. We know that the statutory rate is 21%. Why do we have a difference in the effective rate? Because of the permanent difference. So if we would have, we saved $31.50 or 21% of the 15,000. That's 1%. All right, of our net income, or of our income before taxes. So we get an effective rate of 20%. Municipal interest was 1%. That evens out at the statutory rate of 21%. So you can see what the impact was of the permanent difference. All right, coming down to exercise 2. So things get more complicated as we move along to subsequent years. All right, but here is our information for year 2. Our net income, or our income before taxes, 308. We are again using columns. Okay, this is your tax return. This is your income statement. We subtract out the municipal bond interest, just like we did, but we also have a life insurance premiums. We add those because those are a situation where they are not deductible on the tax return. So our tax return, taxable income is going to be higher. So subtract that one, add that one. And before we do any temporary differences, our permanent differences have brought our income on the tax return down to $296,700. Okay. Bad debt's a little tricky. We have the $7,500 allowance left over from last year. It told us that our $20,000 was written off. That's what we get to deduct on the tax return, is what we actually write off. And we said that they told us that there was an estimate of 2% of $840,000 in the allowance. So there needed to be allowance after we make our adjusting entry. So to get that 16.8, we had to credit the allowance for 29,300. So that's how much bad debt expense is part of our net income. The difference between what we can deduct on our tax return and what we could subtract on the income statement is 9,300, which is part right here. The difference between the two. Okay, so that's how much, because we did the 20,000, okay, but the income statement is at the 29,300. Okay, so we have to add back the 9,300 to get back to our taxable income. So we can only deduct 20,000. Unearned revenue, we got 11,000 of rent for the next year. We would not count that as income on the income statement, but you have to on the tax return. So there's the 11,000 added in there. Okay. And then we have the depreciation. We're keeping track as we move along. Okay. This is year 2 for the 2024 equipment. Okay. So they have been depreciated for a year and a half year in the first year and then a whole year. Okay. But remember, that was all depreciated on the tax return. 58,000 already. So the difference so far in total depreciation on that equipment is 571. Some new equipment. Okay, we are going to use the 5-year useful life, so it's depreciated 819 according to straight line. And we took, again, for tax purposes, all the depreciation in 1 year this year. Okay, so for the 2024 depreciation, there's a difference between what we took on the tax return and what we took on because the tax return has 0, right? Because we took all the depreciation last year. So no additional depreciation. You don't get extra. You just get the same amount. You just take it in a different year. All right. So any amount that's on the income statement, okay, it needs to be added back. All right, to get the tax return, because we do not get any deduction. So we add back 8286, and then the other depreciation, because we took more on the taxes, okay, then we subtract for that extra that we get to deduct on the tax return, okay, the difference between the income statement, 7367. Now you can put those together, and we will as we move on to later years. But right now, I wanted to break it out so we make sure we can see that both of them have an impact and how they both impact the situation. So tax return shows taxable income of $317,919. In this case, because of these differences, we actually end up with more taxable income than we had on our income statement. All right. So tax expense and tax payable is 21% of the $317,000 taxable income. There's our journal entry. All right. The deferred tax liability refers to our depreciation. So if we look at depreciation, the total difference of depreciation, and again, you could do these separately or together. We did it separately up here, but we're going to put them together when we make our journal entries. Okay. Is 52,938. 21% of that, you get the idea that always is 21%, right? Tax liability. We should have a deferred tax liability of 11,117, but we had a deferred tax liability of 11,310 last year. Okay, so we actually have it go down. So we need to debit the liability and credit the tax expense. By comparing it to the year before, you always know the right direction to go. Okay? You can always get the amount, or you can usually get the amount from over here, the differences, but to get the direction, you need to compare this year's liability to last year's liability. And that tells you it's going down, so we need a debit, credit the tax expense. Deferred tax asset, our allowance, 16.8 this year, okay, which is a deferred tax asset of 35.28. Last year, that deferred tax asset was 1575. So the difference is 1953. We're going to make the asset go up, 1953, and credit tax expense. And then we have this new one that we didn't have last year. So we don't have any comparison to last year. We just take 11,000 times 21%. create this new deferred tax asset and credit the expense. All right. So your tax expense is tax expense, debit, credit, credit, credit. So this minus this minus this minus this. 62,307 net income is 245. Current is the 66. The other three added up are the deferred. Okay, that gets us to 62,307, and then here's our effective tax rate. We take the tax expense, we divide by the income before taxes, we get 20.23. We know it's supposed to be 21. What happened? Well, we have 3255, or the tax that would have been paid on the municipal bond interest, but is not. That's at 1%, 1.06%, and then we have the life insurance, which goes the other direction. Okay, made our rate go the other way, and so we end up with 21%. And I extended it out, put the decimals in there so you could actually see that with enough decimal places you can make it actually work. If you get rid of that, this is 20, this is 1, this is 0, and it doesn't look like it adds up. All right, so there is how you can check yourself, make sure you're on the right track before you go on to the homework with this same company for 2026.